CAT modeling is a huge trend in the insurance industry, but Michael Pilla, CEO of Technical Risk Underwriters, which writes builder's risk, standalone earthquake DIC for fixed and completed property, and flood for completed property, says not all models are created equally. In this interview with My New Market's Amy O'Connor, Pilla discusses why most CAT models are creating a false sense of security for the insurance industry and what systems are better indicators of risk and estimators of loss.
I don't think it's honestly helped the business at all. I think it's a lot of, we actually speak to some scientists, and there are companies that would like to think they can predict when events are going to happen and kind of categorize it by how many years it's going to happen and even go further and predict how much damage is going to happen. The people that we've spoken to that are not working for those organizations, what should I say? I believe it's a bunch of hogwash, right? Our analytics and the predictive analytics people we have are really focused more on aggregating risks together, right? Not trying to predict weather and not trying to predict damage. For us, it's more a matter of capturing areas where there might be some homogeneous activity, whether it's a flood in the same area, what types of flood basins might aggregate together in a single event, and even if it's over a period of time, and just being able to count dollar value in those areas, not trying to predict what type of loss is going to happen. I think what we've learned, year in and year out from when the models started being widely used is that they're wrong every time an event happens. Then they come back and charge a bunch of insurance companies a lot more money to hire more scientists to try to fix their models. I talk to a lot of very large carriers and some global reinsurers who are getting fed up with the process, to be quite frank with you. I think in the next couple of years there's got to be a big shakeout in this industry in terms of how much pressure is put on by the regulatory environments and the rating agencies on companies to use some of these models when the models are continually wrong. Some of the more global players like the Swisses and the Munichs and the Hannoverese create their own models, although they still have to use some type of a more widely accepted model. I think it's heading towards a place where something needs to change. I think one of the most important changes is, so some of these modeling companies try to understand how much premium you write and how much of the premium that you write would flow through their models and charge you a percentage. I think what ultimately needs to happen is they need to recognize they're selling you software, just like any other software vendor, and there's a flat cost for that, right? And I think instead of, I know companies that are paying tens of millions of dollars for their modeling where they should be paying several $100,000. And I also think some of the rating agencies need to kind of look at what historically has happened, as a result of big errors by the modeling company, how quickly, RMS comes out with 11.0 and companies realize that they've used way more aggregate and usage than they ever thought they had, right? Now they come out with 13 and drop it again in Florida, right? It's a constant tweaking of a model at a very high expense to the industry, and I think the industry needs to shed some of that expense, need to become more realistic about the value of the models and honestly the science behind the models. Will we ever get there? I'm not sure, but I believe that we really need to go in that direction.